everyone, and welcome to the Global Evening, Global Investment Conference. There we go, I should be in the spotlight now. My name is Francois Stoffberg. I'm an economist and the head of sales at Efficient Group and Efficient Private Clients. Thank you for joining us. I see a lot of people still coming in. So I'll just, hello Tony, welcome, thank you for joining. Yes, everyone, you're more than welcome to leave comments. Thank you, Lizette, in the chat box. We'll do Q&A afterwards, just to make, hello Quibus, thank you for joining, just to make everything flow a bit easier. Just a heads up, I think we had a couple of interesting questions during the first forum that we had regarding South Africa's economics and some of the political issues and consequences. And although we never dodge or try to dodge those questions, I think the idea or the theme with tonight is the reality of the world that we live in, both locally and abroad, but to understand that reality and then to make sure that you receive the sufficient investment and other types of advice that you as an investor or an intermediary needs to make the correct allocation or decisions for retirement. I think that's the goal, to understand the global theme and the global world that we live in so that you can make better decisions at the end of the day. So Davi is gonna be up first. I'll give over to him right now. He's gonna explain this world that we have to live in, especially here in South Africa, and why it's so difficult to do what we do here in South Africa, to invest and make a living. We're a small open economy and we have many challenges. Davi is going to look at that and then also speak more to the growth story offshore as well. And then I'm going to give over, well, let me just say that as well. I don't think I have to introduce Davi Ruet. He is a very well-known, reputable and respected economist. We're very privileged to have him in the group and have him as part of our team as well. Then Rian will take over from there. Rian is the Chief Investment Officer at Efficient Private Clients. You can go and read about all our qualifications if you want to, but trust me, I think we know what we're talking about. Rian has spent a lot of time trying to understand global themes, global thematic themes, how the world, the investment sphere look offshore, long-term, short-term, medium-term. So he wants to touch on, based on this picture that Davi is going to sketch for us, why we invest offshore and how we invest offshore and in global markets, and are there specific themes that we want to invest in and how those themes translate into the companies we choose. Sorry if there's some background now noise. For some reason, there's a mirage flying over my head. I'm not guilty, but that might be a reason. Then afterwards, I'll briefly touch on what this means and how we translate this world that we live in, the themes that we've identified, the industries how we translate that into global investing, how much to invest offshore, where to invest that money, platforms, etc. Based on some of the research we have done, which really coincides with a lot of the prevailing research from Investec, Momentum, and so forth. So it's going to be very interesting. Please post your questions. We will address them as the evening goes on. But for now, let me hand over to David. And I said it the first presentation as well. You can basically just give David the microphone and he will keep you entertained for a whole day long. But we are going to have to cap him, unfortunately, to about 25 minutes today. But we will have more of these events. They will be held on a quarterly basis. You'll receive the invitations for the next one. So this is not for the last time we will be hearing from his wisdom. Thank you very much, Davi. Over to you.
Okay, Francois. Thank you very much, Francois. And you're far too humble for everybody. So you know by now, but it's Dr. Francois Stoffberg, and he's got a lot of other qualifications as well. I just want to check, Francois, can you hear me fine?
It's perfect, and I can see the presentation. Thank you, Davi.
You can see the presentation, and I have 25 minutes, and let's see if I can complete the self-presentation in 25 minutes. I'm pretty sure I will be. All right, before I get to a couple of numbers as far as South Africa is concerned, I thought a good place to start off, as always, will be to understand this thing that we call the economy. What is this thing that we call the economy? Is the economy to use the words of our previous Minister of Finance, Trevor Manuel? He says, what is this amorphous entity? Well, the economy is basically you and I. The economy is people, and economists, what they do, they study why people behave in a certain manner. So the economy is just you and I and how we interact. It's as simple as that. And we use formulas and graphs and all sort of things as tools to understand people a little bit better. But when we talk about the economy, people seem to think that the economy has to do with goods and services and money and stuff like that. So usually when we talk about the economy, we talk about these sort of things. Although other things, like for example, getting married is also an economic decision. So everything, all decisions you always make is an economic decision. But let's sort of narrow it down a little bit to things that's got usually a price tag in front of it. Okay, so before I look at how South Africa is performing, maybe just a few key components that are required before an economy can grow. One are those things that are absolutely necessary before we can even talk about economic growth. What are those things that are absolutely required before we can talk about economic growth? If I can only get my screen to move to the next slide, Francois, can you help with that?
I see your mouse moving.
That's it. There we have it. Let's see. All right, there are 3 golden rules. Now, if you go back in the history of mankind, there were many and amazing economic discoveries. And I would argue that the single most important economic discovery, and there were many, I mean, the discovery of the wheel, the discovery of fire, all those sort of things were important. But as far as I'm concerned, that single most important discovery that set this whole wheel in motion was the discovery or the establishment of something called private property rights.
Yes.
Something belongs to me. And that probably happened a couple of thousands of years ago when we first started to domesticate animals primarily. But private property rights is of the utmost importance before we can even start talking about this thing that we call the economy. Now, private property rights is so crucial in an economy because without private property rights, the next greatest thing in the invention of all these wonderful economic discoveries that we've made is free trade or the exchange of private property rights. Now, there's a saying in economics is that there is no free lunch. I beg to differ because there is indeed a free lunch. And this free lunch is trade. And it is a free lunch because once a buyer and a seller decide to exchange goods between the two of them, both the buyer and the seller gain from this transaction.
That's it.
Think about that for a moment. That indeed is a free lunch because just after that transaction, both the buyer and the seller are better off. And nothing really happened. All that happened is that private property rights exchanged hands. So by exchanging hands, by private property rights exchanging hands, you are creating free lunches.
That's good, yeah.
And that's why private property rights are so important, because without private property rights, you cannot exchange private property rights. But there's a bit of a problem. So free trade is an event where a free lunch is created. But there's a bit of a problem because if I have a cow and I want a chicken, I have to exchange my cow for 10 sheep and then 1 sheep for 10 chickens. And now I've got 9 chickens I don't want and 9 sheep I don't want. So there's a bit of a practical problem with trade, but you can fix that practical problem. And that is by the invention of the third most important discovery in economics. And that is the discovery of money. And that's why money is so important, because money allows me to exchange my cow for a piece of gold, for example, and I can put my piece of gold in my pocket and I can spend it tomorrow or next week, or I can even lend it out to somebody else. And if I want to have a chicken, I can break a small piece of gold off and I can actually buy a chicken. And that is why money is so important, because it facilitates trade and it makes trade so much easier. And just as a side note, that is why prices are so important. Prices are important because prices gives us the opportunity to measure the relative value of things against one another. And in order to get the full benefit of money, we must have sound money. Sound money simply means money that keeps its value. And just as another side note, that is part of the reason why the South African Reserve Bank decided to increase interest rates this last week. Many people do not like that because money is becoming more expensive, but that is the only tool that is available to the central bank, or one of the few tools available to the central bank, whereby they can make sure that money maintains its value. If you are a builder and you use some sort of measuring instrument like a ruler, for example, imagine what a building would look like. Or if you're a carpenter and you are building a furniture or a desk, imagine what that desk would look like if the ruler was made of rubber and it keeps on changing. That is what the world is like in a world of high inflation. The ruler, money, keeps on changing, and that makes it extremely difficult to measure things amongst one another. So these are the three most important things. You must have private property rights and the protection of private property rights.
Yes.
You must allow for free trade, and you must have sound money. Now we can already look at these three very important golden rules, and you can think of South Africa and say, is that what we have in South Africa? Private property rights are under threat at the moment. They call it expropriation without compensation. There's a simple word for it. It's called theft. And there are various levels of theft in South Africa. Very high levels of tax, for example, is another example. Or just plain criminality. It's another example of private property rights are being undermined. Free trade is being undermined. I'm not allowed to sell my labor for a price lower than the minimum wage, as an example. Quite often, I'm not allowed to sell goods unless I have a license, for example. All those examples undermine free trade. And despite the Reserve Bank doing a relatively good job, the South African currency has lost nearly 99% of its value the past 60 years. That is a ruler made of rubber, making it very difficult to really get the benefits of free trade, of that free lunches out there. But those are the three important rules. And once you've got that, and once you implement that in an economy, you are pretty much assured that you will have a functioning and a successful economy. All right, before I get to a couple of things in South Africa, just a few things, some international developments that are important to South Africa. Remember, the South African economy is a small, open economy, and what happens internationally will affect the South African economy. Some of the most important developments internationally is that there are significant demographic changes taking place. Most places in the world, or many places in the world, populations are actually getting smaller, including in China, by the way. That means people are getting older. And if people are getting older, their consumption patterns change, as an example. And that's why Riaan is so important when he looks at the money of our clients, to make sure that he capture the value of these changes in demographics, as an example. Of course, not everywhere in the world. In the case of Africa, populations are still growing, but many other places in the world, demographic changes there are significant and important demographic changes taking place. As far as politics are concerned, there are one or two flashpoints. The one that I'm particularly concerned about is around Taiwan, in the Chinese south of China. That potential political clash between the Chinese and the United States, and everybody that support them on their two sides. But there are a couple of other potential political flashpoints in the world. One certainly is in Central Europe at the moment. I'm referring to Belarus. I'm referring to Poland and Russia and Ukraine and places like that. Currently in economics, what's happening internationally, most of the world economy is opening up. That leads to the surge in demand globally. And this surge in demand globally leads to a huge increase in prices. And we do experience significant price increases internationally. Inflation is going up. And that means that central banks will need to react to that. Or put differently, central banks will have to start increasing interest rates in order to make sure that inflation is contained. And we have already seen a number of central banks increasing interest rates, including in South Africa. And the big ones like the Americans and Europeans will probably start following soon. Fiscal policy is exceptionally accommodative internationally, and what fiscal policy is what governments are doing. They're spending money like there is no tomorrow, and in the process, government debt levels or state debt levels have reached record high levels, and this additional spending also ends up in a form of additional demand globally, also pushing up inflation. But in the meantime, economic growth is doing quite well internationally with all this stimulation. The economy globally can only do much better than what they've been doing the last year and the year before. So we do see very strong economic growth globally. So that's some international developments that are important to South Africa. Coming back to South Africa, economists, what we typically do, we look at certain numbers, we look at certain figures, and we put it on a graph. Like, for example, we will put economic growth on a graph over time to see how we're performing compared to how we did last year and the year before. We can quite often put things like inflation on a graph. Riaan and his team, what they do, they put the price of the various stocks on a graph. So the price of Microsoft has been going up from so much to so much, and you can see it on a very nice graph. What economists quite often do not do, and we should be doing more of this, is that we should actually measure things against similar kind of other things. Now, let me give you one example, and that is that in South Africa, we are today much better off than 25 years ago, than in 1994. We are better off in terms of per capita GDP. The problem is other countries are much, much, much better off than us. Yeah. But how much more? And this is what I'm going to show you over the next couple of slides. Now, what do I have here? Thank you, Franza, for assisting me with these graphs. Now, what I have here is South Africa's per capita GDP, or let's call it our income, since 1994, and that white line is the world's per capita GDP. So we kept the world's per capita GDP stable, and we calculated South Africa's per capita GDP relative to the rest of the world. So in 1994, South Africa's per capita GDP was approximately 85% of the world's per capita GDP. And as you can clearly see, that came down quite dramatically the last couple of years. And today, South Africa's per capita GDP is less than 65% of the world's per capita GDP. The purple line at the bottom is the world. So how do we compare to the rest of the world? In 1994, our per capita GDP was 2.6 times that of the world, and today it is 2.2 of Africa. Today it's 2.2% of Africa. This is comparing to Africa, and although we're still significantly wealthier than the rest of Africa, what is clear is that the rest of Africa is catching up quite rapidly with us. This is South Africa's per capita GDP compared to the Chinese. Now, I know people are going to say, but you can't compare it to the Chinese because they've experienced an economic miracle. Yes, they have, but why couldn't we? In 1994, our per capita GDP was 4.5 times that of an average Chinese. Today, it is half of the average Chinese. This is South Africa's electricity generation. We all know what's happening to electricity in South Africa. Remember, this is a moving average graph. So actually, in 1994, we generated more electricity than the rest of the world on a per capita GDP basis. Today, we generate less than 65% of the world's per capita GDP. And if you don't generate electricity, your economy will not grow. Relative to China, in 1994, we generated nearly 6 times as much electricity as the average Chinese. Today, we generate less than the average Chinese. And we can see that in economic growth numbers. Government state debt as a percentage of GDP. We have a huge problem with debt in South Africa, state debt levels, and today South Africa's state debt level is higher than most countries in the world, although there are a couple of countries with higher debt levels than ours, but on average, our debt levels are higher than that of the rest of the world, especially the emerging economies of the world. Sometimes you can't look at graphs over time, you have to look at the snapshot. This is a snapshot of Southern. Why is it that we're not doing very well? There are many reasons. I'm going to touch some of those reasons. But here's a very important reason, is that the quality of South Africa's education is absolutely horrible. This is the so-called TIMSS study, which compares South Africa's grade 8s on mathematics and science students, and how we compare to the rest of the world. And as you can clearly see, the red line, we not only quite bad on these sort of things. We are quite often the worst in the world. Interesting, if we look at the two last countries there, it's Morocco and South Africa, the countries that have been measured. South Africa until recently was the biggest exporter of motor cars on the African continent. Today, we have been overtaken by Morocco. And another side note, South Africa used to be the most sophisticated country on the continent of Africa. Today, it is not South Africa anymore, it is Egypt, in fact. And part of the reason for that is because we do not have proper skills development, also called education. Life expectancy, as far as I'm concerned, this is perhaps the single most important number because life expectancy correlates with everything that is good. The white line is the world's average, and the blue line is South Africa. In 1994, life expectancy of South Africa was roughly 95% of the world's life expectancy. Today, it is closer to 85%. And you can quite clearly see the collapse in life expectancy of South Africa from around about the end of the 90s. And that was, of course, because of the AIDS policy of the ANC then, especially President Mbeki then. Yeah. Subsequently, especially from 2006, it was actually the Treatment Action Campaign. But let's give Zuma the credit for that. It wasn't really him. But let's say that's the only good thing that I can think of that Zuma ever did. And you can see the substantial increase in life expectancy since then. But compare South Africa to the rest of Africa. The purple line is the rest of Africa. And today, South Africa's life expectancy is even lower than that of the rest of Africa. And of course, people know these sort of things. So you can see that in various indices of perceptions. The rule of law, the perception of rule of law in South Africa, need I say more? We are quite a country, a violent country with no respect for the rule of law, or at least that is the perception. This is World Bank data, by the way. Corruption, perception about corruption, it is stone bottom, at the bottom, at 0. There's no, the perception is that corruption is completely out of control. The effectiveness of government, and we all know that we have a government that is very, very inefficient, but people actually see the ANC government as a corrupt government, as a criminal organization in a way. But I've got a suspicion that the effectiveness of government is having a bigger and a more negative impact on economic performance. It's one thing to have a corrupt state official. You can bribe him to get the necessary license or whatever you need. But it's something completely different if you have a completely, totally inefficient or ineffective government official, because you can't, it doesn't do anything, whether you bribe him or not. So that's probably costing us more in terms of economic performance, and that's the effectiveness of the state. This is an interesting graph in the early 90s or the middle 1990s. The terrorism or the perception of violence and terrorism was quite low. That was, of course, a transition, the political transition in South Africa. Subsequently, that improved quite nicely. And recently, that came under pressure again, and one can simply refer to what happened in KZN and Gauteng a few months ago. Okay, a few highlights for the local election. The ANC was, without a doubt, the biggest loser. The DA disappointed in the Western Cape, but they gained in some weird places, especially in KZN. That was quite interesting. IFP is back in KZN. The EFF reached its peak. They did actually quite bad, much worse than what many political analysts expected, including myself, by the way. I think they've reached a peak. I don't think we're going to see much more of the EFF. Action South Africa actually surprised. A couple of smaller political parties also quite surprised. And I think it's obviously time for coalition in South Africa. So the political landscape is going to change quite a lot. Just a few numbers that are important. So we've got an ANC, and this is what we have today. We've got 12 million people with jobs, or rather 12 million people without jobs, unemployed people. We've got 14 million people that are actually employed, people with jobs. But of that 14 million, 12 million, or 2 million of them are actually civil servants. We have 18 million people that are grant recipients, plus 2 million civil servants, giving you more than 20 million that people that receive an income from the state every month, plus the 9.5 million people on this special COVID grant, which gives you 30 million people receiving an income from the state, and 12 million people actually paying for those salaries. So 30 million people get an income from the state every month. Now, if you analyze the budget of the Minister of Finance, it's very clear we simply cannot afford this. And the Minister of Finance is planning to cut back on that spending, the wage bill and the grants. And that means, and it will happen, whether he plans to cut back on that or not, we will spend less on 30 million people over the next couple of years because we ran out of money. As simple as that. So in the real terms, their income will fall. And that means that if we will take money away from 30 million people, and that means 30 million people will get angry. So we saw what happened the past 4 months ago, so KZN, and I'm afraid a repeat of that is quite possible. This is an interesting graph, and that is the exchange rate of the currency, the rand. The currency is currently trading on its way to 16 to the US dollar. This is a combination of so-called purchasing power parity approach. You may know this as the Big Mac index, a little bit more sophisticated, but it comes down on the Big Mac index mix. And with that, we also mixed in the average undervaluation of the currency over time. And this gives us a gauge, an idea on where the correct level of the currency should be. So the currency should be between 14 and 60, roughly speaking, meaning that where the currency is currently trading is more or less in line where it should be trading. And maybe I can just make a comment, if it hasn't been for a very strong commodity cycle, the rand probably would have been a bit weaker. Point is, it's a good idea to take some of your money out of the country, and the current level of the exchange rate of the currency is more or less in line for taking money out. It can go weaker and it can go stronger, but if the rand was trading at 90 to the US dollar, I would have advised my clients to wait a little bit, while if the currency was trading at 12 rand to the US dollar, for example, I would really encourage people to take out a huge amount of money or everything they could. Currently trading at just below between 15 and 16 is more or less fair value. A couple of things that, just a few, and I will rush through this because Rian will give you more information. There's a couple of industries that I really do like. Agriculture, I think there are amazing things happening in agriculture, and don't be mistaken. Agriculture is not a dirty industry anymore. It's not an industry where you walk on a farm, you give that to drones. Agriculture's real value add happens somewhere else, in a lab at the university. Agriculture is a wonderful industry to be invested in. Unfortunately, our politicians think that land is value. It's not land that is value, it is what you do with the land. Medicine, yes, especially personalized medicine, that is I think there are amazing things happening there. Education, last year I was a grade 1 teacher, and I was absolutely amazed with all the tools that are available. So education is already undergoing a real revolution in the way that people are being educated. It's really getting democratized, if you like. Finance at various levels. Finance is changing, especially with the introduction of new things like, for example, blockchain technology and everything that goes with that. We do a lot of research on that. I'm not advising people to rush out and go and buy Bitcoin. That's certainly not what I'm saying. What I am saying is that technology is changing in a way that we understand finance is going to change quite dramatically. I can even go as far as saying that banks, at least the way that we understand what banks are likely to disappear. So yes, that finance is changing dramatically. Just in a nutshell, the medium-term budget policy statement, there's the GDP economic growth for this year is set at just over 1%. But thereafter, the Minister of Finance expects economic growth to slow down quite significantly. The GDP of 5%, there are some technical reasons, but some real reasons, like a strong commodity cycle, for example. The grants, the Minister of Finance said he's not going to extend that 9.5 million grants. That will be a cabinet decision. So he's very, very cleverly passed the ball to cabinet. The budget overrun on revenue is approximately, according to the minister, about 120 billion. I think it's conservative. It's probably going to be much more than that, 150 billion. That's a sign of a Minister of Finance that is relatively conservative. Of this 120 billion, 80 billion has already been allocated to things like Sastria and a COVID grant. Privatization is actually happening through the back door. We indicated that a third of the railroads will be available for private users or investors, like the private sector is allowed to generate electricity as well. The deficit at 1.1%, 7.1, and the debt at 70% of GDP. Just go to the top one there, And the Minister of Finance tells us he expects 1.7% economic growth over the next 3 years on average. Now, do you want to vote for a political party that tells you that they ran out of ideas, that all they can do is tell you that they expect economic growth of 1.7%? Is that the best they can do? Why don't they at least lie a little bit? But I'm afraid that is what we have. We have a government that's reached the end of their ideas. They simply do not know what to do anymore, and they simply ran out of policy options to grow the South African economy. So that's a short summary, Francois. I did it all in time, exactly on the spot in time. So if there are any questions, of course, I will be happy to take those afterwards.
Thank you very much, Dawie. Just before I give over to Riaan, as I explained, please type your messages. If you have any questions in the chat box, you'll see, if you just scroll down, you'll see a little chat icon. You can open that and send a message, and then we can address those questions. Thank you, Dawie, for your presentation. I think it was very insightful. Even though I did help you with the slides, it's always interesting hearing your different perspective on it. Riaan, so over to you. Thank you very much.
Hey, thank you, Francois. Can you hear me fine?
Hear you fine, and I see the presentation as well. Thank you.
Great. Good evening, everyone. Hello. It's a nice Monday evening, not raining currently in Pretoria. Very nice to speak to you. I see there's quite a few of my colleagues and some clients, and hopefully a few new clients and so on online. So welcome. I'll try and not be too boring. I'm typically the boring part of the presentation, but I'll try.
That's a lie. That's a lie.
I head up the investment team at Efficient Private Clients, and we typically, we manage our clients' global wealth. We construct globally focused direct equity and direct share portfolios for our clients, but we also manage a few other solutions. We manage a global equity fund, and I'm speaking to you tonight in my capacity as one of the co-managers of our BCI Global Equity Fund. Francois is going to spend a lot of time on this, but some of the questions we get from our clients is, why do you want to go offshore? We always say to clients, the JSE is about 1% of the global market cap. That means that there's about 99% of investable ideas outside of the JSE, and that includes many sectors and industries and themes that are either sparsely represented or not represented at all. So we sort of see the global equity market as a superstore. And Francois is going to touch on this as well, but it has been proven that the appropriate levels of global exposure enhance your diversification, it improves your risk, and it reduces your returns. Well, it increases your returns and reduces your risk, rather. Let me say it the other way around. And why the equity fund? We believe that the world should be our investment arena, and I'm going to spend some time on why. Myself, Etienne, and Renier, we're the main managers and analysts on the fund. We're supported by 3 economists. Now, you'll have to ask an economist if you need 3 economists. I see there's a question, and Francois, I'm going to leave the questions till the end if that's okay.
Yes, perfect.
You need to ask an economist if you need 3 economists. It's a very difficult question, but we have them and we use them. We're also supported by quite a big team that helps us with analysis and quantitative analysis, etc. From there, it's quite a long investment process, but what we want to get to at the end is we want to construct a world-leading portfolio for our clients. What we see as a leading company is a company that has a sustainable competitive advantage or economic moat. So there's something within this company's business model that allows it to preserve its ability to make money. An example I always like to use is a company like Nestlé. They have 34 brands that earn more than 1 billion Swiss francs a year in revenue.
Wow.
What that means is they can invest behind their brands to make sure that they keep market share and grow their top line, and of course, grow their bottom line as well. But that's not the only thing, and this is where a lot of economic analysis comes in, is we want to make sure that we're on the right side of the global economic trends we are seeing. There's quite a lot of stuff happening in the global economy. Last week, we got some very strong retail sales numbers. And while that's important in the short term, in the longer term, that doesn't really matter. What's important is who's structurally winning and who's structurally losing. And we spend a lot of time understanding and analyzing those themes and trends There's a couple of big ones. We're getting older. David touched on it, especially in the developed world. We're getting quite old. There's about 30%, well, about a third of the Japanese population is now older than 65. And that has a lot of implications for that economy. We're also getting richer, especially in the emerging world, and that's being driven by China. India is starting to pick up as well, and that's a trend that we'd like to get involved in. And of course, we do a lot of analysis on the various companies and so on to get us that exposure. And we're also urbanizing. We're not moving into city centers anymore, but people are still moving closer to cities. And that's a lot of implication on things like transport and so on, city development, city planning. And, you know, just the practicality of it. We live in 3D, but we travel in 2D. And that has a lot of implications for how you build a city. As I said, the end of it all is to construct a portfolio of what we think are the world's leading companies, and then not to overpay for these companies when they trade at attractive prices. And what's interesting with the current global setup is basically the three big economic blocks, the US, Europe, and China, they're in different places. What we saw at the beginning of the pandemic, or just before the pandemic, is global economic growth was quite synchronized. But because of the way countries handle their lockdowns and their vaccine rollouts, the various economic cycles in which these countries find themselves and these economic blocks find themselves in vary quite a bit. In the US, we're approaching sort of a later cycle. We're getting towards full unemployment. I saw Jerome Powell got re-elected. That's quite good. But that means that interest rates are going to start picking up, most likely sooner rather than later. And that has the implications for the types of businesses that you want to own. In a rising rate environment, different businesses outperform than in a falling rate environment. Also, the consumer is still very strong. As I said, we got some strong retail sales numbers out. There's about $2 trillion in excess savings, depending on whose numbers you believe. On the sidelines, that's still finding its way into the economy. So they're quite a nice underpin, and that's leading to some inflationary pressures and so on as well. And that's quite, you know, when you look at the US economy, that makes it an interesting sort of phenomenon, because if you look at sentiment data, the way people feel, it's actually quite low. But if you look at the hard numbers, the GDP growth, employment, people resigning, about 6% of the US workforce resigned in August and September. So that's numbers that tell you that people aren't too pessimistic about the future. And of course, the big difference, the differentiator there is inflation. If you think stuff is going to go up, that makes you a bit more bleak. But still, for now, we like the US. We think it's a very strong economy. Of course, we are wary of some valuations in that economy and some of the market, some of the stocks that we want to buy. Europe is in a bit of a different space. Europe was slower to roll out their vaccines. I don't know if you remember, it was quite stop-start at the beginning. They're going into a new wave now. The biggest difference between Europe and the two other main blocks is they don't have it's a monetary union, but it's not a fiscal union. So stuff like infrastructure plans and so on take quite long to roll out. That's positive for the current market setup, because the European economy is going to be the fastest growing economy next year in terms of the free. On our numbers, we think it's at least going to be relative to this year, the only economy that's actually going to grow faster next year than this year. And that has implications for the sort of companies we look for. Also, the Europeans still have their recovery fund that they have to roll out. There's going to be a lot of infrastructure investment and so on to look out for that should support markets as well. And they don't really have an inflation problem, so rates are going to stay lower for longer. So that's also positive. China, of course, had a few issues in terms of their credit market, in terms of regulation on their technology companies. A lot of that is in the price, and we are starting to nibble at Chinese companies. We will never take a massive exposure, but some of the valuations are becoming quite compelling from where we are now. Of course, the biggest thing is how fast Jerome Powell is going to raise interest rates. If that's going to happen fast, then it doesn't matter how attractive valuations are. Interest rates are going to go up faster, which is not good for emerging markets. Maybe just on some of the sectors, David touched on some of the sectors he liked, and that plays out through our portfolios. In the healthcare space, we typically like companies that are a bit further away from regulation. Yes, the world is aging, but typically the person receiving the healthcare service doesn't pay for it directly. Who pays for it is either a medical aid or a government. So there's a lot of pricing pressure from those big, if you want to call them clients. And that means that we prefer to invest in drug originators, and we prefer to invest in medical device companies where there's at least some form of pricing power. As I said, that's quite important, this ability to preserve your, ability to make money, I guess. Technology, that's also always going to be a big component. We like long-term growth stories, and technology is obviously a big part of that. That's not just your traditional Amazons and Microsofts, although we are investing in those companies, and Microsoft has been doing a lot of the heavy lifting in our portfolios for us this year. But we also invest in some of the slightly smaller, still big in South African terms, but slightly smaller businesses that are doing quite well and where we can see a long run rate for them. In the finance space, we typically avoid businesses that need rising interest rates or falling interest rates to make money. We prefer to invest in businesses where we can get an idea of where their longer term outlook is going to go. For instance, we own a few asset managers in the US and in Europe. We own the credit rating agency S&P and a few other of those as well. And the consumer space, we also try and focus on the way the world changed. You know, the way we consume stuff changed dramatically in the last 2 years. Satya Nadella, the CEO of Microsoft, said that we saw 2 years of digital transformation and adoption in 2 months. And that's something that's going to stay with us for quite some time. And then the industrial space as well, we focus on businesses that are well positioned to make money in the way the world changed. Some of the stock specifics that we like, I see about 3 minutes left. Some of the stock specifics that we like, we recently took a position in LVMH. We think that's one of the best equity stories in the consumer space. We also think it's quite a nice reopening story. Of course, with all the pressure on China and the COVID waves, there has been some pressure on the stock. We think it's a bit overdone at these levels. And with brands like Dior and with shops like Duty Free Shop and Sephora, which sells makeup and other cosmetics, we believe they're quite well positioned for a reopening economy. And also, as I said, Chinese headline risks were a bit overdone. PayPal has been under pressure recently. It started when they wanted to buy Pinterest, and there's a few other things happening in the payment space as well. We think longer term, this is going to be one of the big super apps. It's a trend that's actually started in Asia and China. It's now developing across the world with various companies looking like they might win in this space. And we think PayPal can actually win in that space as well. They have relentless innovation. They're also profitable, which is important to us. They generate about 4 billion in cash flow, free cash flow a year, so they can chase some acquisitions. So we think it's a well-positioned company. Everybody always talks about the chip shortage, at least many of our clients speak to us about this, and they ask us how we invest in this space. So what happened was, obviously, the world locked down about 18 months ago, and then people got stuck and they had to work from home, but they didn't necessarily have laptops and tablets and cell phones, and they went out and bought those. That meant that all of the chips and all of the semiconductors in the market went to the consumer electronic businesses. And when the car industry started to ramp up again, they were quite vulnerable because they didn't have supply of chips. Also, because of the trade war, you know, a lot of countries they see sort of chip manufacturing as the new, or chip manufacturing security rather, as the new oil. So that's something that clouds the portfolios, but we always look for businesses that have a competitive advantage and an economic moat. And we invested in ASML. It's doing quite well for us. It's a position we've had for some time. They manufacture these machines. It's as big as a bus. It costs 100 million euros. And their order book goes out to 2026. And what it does is they're the leaders in photolithography. And they own 100% of the ultraviolet photolithography market, which means that competition is not that tough for them. So in the shorter term, the chip shortage still helps sales. In the longer term, the sort of race to get your own fabrication in your own country is a longer term supporter as well. As I said, they have most of the market, 100% of the ultra UV market, so doing quite well in that space. And then maybe lastly, we also still like Disney. It's a position we've had for quite some time. The streaming industry is interesting. You know, the leaders in the paid streaming market is, of course, Netflix, and the leaders in the advertising-based market is is YouTube. Netflix and YouTube both earn about 7 billion. So it's a very like-for-like business, actually. We think one of the other businesses, especially the paid services market, is going to be Disney. They got the adoption they were looking for in their Disney Plus service. They were looking for about 60 to 90 million users by 2024. When they launched the service in 2019, and it took them only a couple of months to reach those numbers. And now they're targeting far more aggressive numbers. And we think that's a quite longer term growth driver. It's not fully in the price of our numbers. In the shorter term, we think Disney is also a nice recovery story. Their theme parks have been running quite lean. So although occupancy will only recover to 2019 numbers in 2023, profitability will recover a lot faster. Of course,
Yes.
They own a great portfolio of brands. This business basically monetized many children's childhoods. So quite a nice business model and quite a strong economic moat. At the end of the day, what we want to do is we want to construct a global equity portfolio that aims to provide investors with high long-term capital growth. And we really want to invest in quality businesses when they trade at attractive prices. Thank you for your time. It was very nice to speak to you this evening. If there's any questions, I'll take them afterwards. Francois, back to you.
Cool. That was very quick, Riaan. You could have used some more time if you wanted to. And I always say about Disney. If you've ever been to one of the parks, then you understand why we invest in Walt Disney. I still love the stock a lot. I'm going to wrap it up in terms of what we've heard. Dawie explained quite in detail in terms of why it is difficult to invest in South Africa. I think as investors in South Africa, both myself and yourselves, we know that markets have been tough over the last 6, 7, 8 years. We had a good year last year, but I think, like Riaan tried to explain, is that there's a lot of opportunities offshore. He showed actually quite nicely that the JSE is less than 1% of market capitalization. It means that if you're not adequately invested offshore, you're missing out on 99% of the opportunities. I think that's the bottom line. So last year, our chief executive, Heiko, asked that we should look into this and try to determine what is a good investment offshore. How should it look? How much should clients actually be investing offshore? And we took that mandate to heart, and we really did a lot of research, and our team at Naviga helped a lot. The team at Efficient Wealth helped a lot. Our team did a lot of research, and we found out that our results actually coincided with what the industry was already showing, that an investor should have between 40 and 60% global exposure. Investec had the same results, Momentum had the same results, Mutual had the same results, but no one was executing on it. No one was actually offering clients the ability to get that 40, 50, or sometimes even 60% global exposure. So we put it in a very nice, simple to use and understand setting in a website. I've shared the link with you in the description box. I'm going to take you through the website and our findings to show you the power of investing offshore or an adequate amount offshore. You should be seeing my screen there. If you follow the link, you'll see it in front of you. And basically, what we found is that it is important to invest offshore, but what's most important is the investment vehicle you use to invest offshore, the structure you use to invest offshore. And that is an underlying question of the advice you receive. Everything we found starts with the question of advice. Did you receive quality, independent, holistic financial advice? Did a client receive quality, independent, holistic financial advice? That is the be all end all. It starts there. And from there, which manager you invest in, like you know, we use Naviga as a model portfolio. We invest in the best managers in South Africa. We don't necessarily invest in only our products. And the reason we do that is because we found that is the underlying tone. It starts with independent advice. And the result of independent advice is that it is more tailored to a client's specific needs. I just also want to, from the off the cuff, well, not off the cuff, actually, our research showed that is that there is no investment horizon that shows that taking all your money offshore is the best investment alternative for an investor. There is no published research in any journal article anywhere in the world to prove that. So people or the media sensation that hypes up a story like that, that is completely false and should at all times be avoided. It has a lot more to do with understanding your individual needs and investing into those needs to reach specific objectives. So that was the starting point, and actually then the ending point was to say that yes, you should have exposure, you should have 40 to 60% global exposure, but that question gets answered at the starting point, and that is, do you have the right type of financial advice? What we found is, based on the research, Momentum and Sanlam, they have these surveys that goes out every year. They survey about, I think it's 2.2 million investors in South Africa, and see where these clients are invested in, how much global exposure do they have. And what they found is, because of Regulation 28 and because of not receiving the best financial advice, most investors don't have sufficient global exposure, don't have at least 40% global exposure. I think for a very long time, not necessarily in the case at Efficient Wealth, for a very long time, the standard advice was, I'll just put you in a portfolio, in a regulated 28 portfolio, and then it's done. My work is done. Sort out your medical aid, do maybe some short term, and then put you in a portfolio. That's not the best advice. And we showed that, not just ourselves, like I said, Investec and all the rest actually showed as well, that clients need more global exposure, but they weren't receiving the advice that they need to put them in the right exposure so that they can get that quality advice. Here's just one example. What we did is we showed that if you invested 150,000 Rand, according to the average investor profile, that 2.2 million people that are surveyed every year, then that 150,000 Rand would have accumulated to about 473,000 Rand. Still a good investment, you did well. If you just had more global exposure, just 40%, not even 45 or 50% or 55%, just 40%, instead of the 25% average that investors had over this time, then you would have had about 75,000 Rand more, which is almost half of your initial investment. That type of story makes a life-changing difference at the end of retirement. And on this website, which we designed then, is if you go to the top, you'll see that there's a tab here, Global Advice. And this breaks it down because we understand that investors are at different stages of their retirement planning. They understand now that they need holistic and independent financial advice, so that they can end up in the right solution that is having enough global exposure. And then you can cherry pick your specific, what do you call it? Your specific manager that you want to invest in, whether it be Investec, PSG, Allan Gray, whoever. So in a pre-retirement space, what we really focused on here is that, once again, looking at the average investor and looking at what we call an efficient global investor, someone with enough global exposure. We ran many different simulations from 1980, 85, 1990, 1995, 2000, and all the way through until 2020 to see if an investor invested, because that was the advice that was given back then, 100% into a pension fund, how would that investor look after 40 years? That's the sum that we did over here. Or let's say an investor did the opposite. He'd only invested 50% in a pension fund, and then the other 50% he invested in other tax-free, tax-friendly structures. I know the tax-free savings accounts are quite recent, but we had local and global endowments before that were already a lot more tax-friendly. So you have the 100% allocation to pension funds, and then a 50-50 towards pension fund and some other tax-free or tax-friendly structures. And what we found is that although the individual, because of those tax credits, has a greater allocation, has a larger investment pool at retirement after 40 years of saving, the guy who invested only in a pension fund has more money in net when he retires, but he has 20% less income. And that's the important thing for those of you who are close to retirement or have retired, or knows who has a mother or father that has retired. What you have, the sum of the money that you're left with isn't as important as the income that you have. And the reason the second option has more income is because of those tax-friendly structures. You know that when you retire, of course, you pay personal income tax, and usually that's at a higher bracket than you would in a more tax-friendly structure. The other benefit of having allocated more funds not to a pension fund, but to a discretionary allowance or a discretionary investment, is that that money is exactly what I'm saying, is to your full discretion. And that's the beauty of it. Whereas someone who only allocated money to a pension fund only has about 5% tax-free discretionary money when he retires. Someone who invested 50-50 has up to 30% tax-free discretion, which he or she then can take offshore, invest in private equity or wherever he or she would want to. And that freedom really is something that we found a lot of investors actually want when they retire. Then post-retirement, I'll just touch on something briefly over here. What we found is that not only are you better off if you invest more globally than locally, we found that this is a simple example showing that if you invested 1.5 million, according to the average investment portfolio in South Africa, what the average investor, those 2.2 million did, that 1.5 million would now be worth about 4.7 million. If you only had a slightly higher allocation to global equity, global bonds, global cash, global investments, you would have had, that is 700,000 Rand more at retirement, just having more global exposure. And the reason that is twofold. One, there are more opportunities, as Riaan showed and illustrated, and more opportunities usually means better returns. Two, your better return, well, three things then. You're better protected against local uncertainty, the depreciation of the Rand, which we know. But most importantly, I think, especially for a pensioner, is that you are protected from volatility. And reducing that volatility over the long term means your capital is preserved better. And reducing that volatility actually means that you end up with more money when you retire, or at least after tax, more money when you retire. So please go through this website. You're more than welcome to send an email. You would have received an email correspondence to your email address, global investing, that you can send an email to, or invest@efpc.co.za. If you have any questions, and then we can follow up, or just write a message in the textbook and we can follow up with you. I'm going to stop sharing there. We have about 4 minutes left for questions. Thank you very much, I'll just say, for your time already. Dawie, I think there was a question for you initially. Let's maybe start with that one. Quibus asked a question about gold. Do you think gold is a good medium or long-term investment? He used the example of Troy Gold. I know we know a bit about Troy Gold. Can you maybe just give your 2 cents about gold as an investment vehicle? If you're still there, Dawie, I see you are here. Or else, Riaan, maybe you can jump in. I know we've debated this for quite some time. As they get ready, I'll quickly go on this. Riaan, let's see if we can get Dawie. Riaan, do you want to jump in?
Yeah, there's a few issues we have with gold. I think gold is a very good hedge against the inflation. Currently, there's a few other hedges in the market as well. But it's been a hedge against inflation for thousands of years. So that is typically the appeal with gold. And also it's finite, the amount of gold being mined is growing by 1 or 2% a year. So it's the supply isn't increasing as quickly as some other stuff. If you want to compare it to the US dollar, about 1/3 of all US dollars were printed between now and the beginning of 2020. So the supply is under a lot of control as well. The issues we have with gold is that, it works on the greater fool principle, which means that you only make money if somebody is willing to buy it from you at a higher price. There's no intrinsic value creation mechanism. It's not a business where you reinvest, where you make money, you reinvest in your business, you grow your earnings, or you pay dividends, or you go and buy another business, or whatever the case may be. So it doesn't have that internal value creation mechanism, which is a problem for asset managers. And the second thing is that it doesn't pay you any interest. So typically in a rising inflationary environment, interest rates go up quite quickly as well, which makes non-interest bearing instruments like gold a lot less attractive. So those are our problems, but I think it has proven its merit as a diversifier in portfolios. So it's not to not own any of it. There is space for it in a portfolio, but don't go and put all your money in gold.
Yeah. Dawie, you want to add something maybe?
Yeah, the only problem there are a couple of reasons why you want to buy gold. That's a question about gold. Is that correct, Francois?
Yes, please.
There are a couple of reasons why you would want to buy gold. One is that if you think we're going to see very high levels of US inflation, that's one reason. The other reason is if you want to run somewhere, put the gold in your pocket, you can run somewhere. The third reason is that if you have some sort of sentimental value to gold. And the fourth reason is to seduce women. Those are the four reasons that I can think of why you would want to have
So
gold.
bad.
I'm not very keen on gold, but the reality is that gold has proved itself to be a reliable, let's call it money, sound money for a very long time, for many thousands of generations. And for that reason, I guess one can have some part of your portfolio invested in gold, but I won't put it in gold as such, but I will put it in something that generates some sort of income, like, for example, gold shares, as an example. And of course, other reasons that I've mentioned, but the gold as such, I'm not very keen on. It's pretty much the same reason why I'm not very keen on property. On top of gold, the property has got the additional downside in that the transaction cost is very high and the liquidity is very low and maintenance costs and all that. So, but I'm not a great fan of gold. But I guess, like Rihanna said, there could be somewhere a space for gold.
Yeah. Rian, just
I'm just glad he didn't contradict me completely, because that would have been
just a question on the fund minimum amount for the Select Global Equity Fund. Minimum investment?
So the minimums depend on the various platforms. They're quite low. So on our internal platforms, on the BCI platform, for instance, the minimums are quite low, but we'll send through all of that information.
And the platforms where it is available now, where BCI, Investec, or 91 and?
Yeah, it's on Investec, 91, Momentum, and the other platforms it's going to be loaded on the other platforms in the next couple of weeks. It's going quite quickly. Yeah.
That was just another question. And then I see there's a question. We are looking at moving money to Mauritius and buying property there. Is this viable? Please send me an email. We do a lot to help clients structure their international trust and businesses and move some of their assets offshore. Then we can discuss that in a bit more detail. I did put in the email address there. It's info@globalinvesting.co.za. I think that question just deserves a little bit more attention, but yes, it is viable. So usually you would want to do that. Then you can get a visa, a Mauritius visa or passport, sorry. And then from there, you can actually quite easily apply for a Euro visa as well. So yes, please speak to us. We can help you with that. Then there's a question, Barry, thanks. No, we did not subtract fees from those examples because every other advisor platform and investment portfolio charges different fees. So we that is gross, it's not net of fees. Then Herman, a question about crypto. I've been doing a lot of research about this. Myself and Davy since 2017. We can probably speak the whole night about that. Yes, cryptos is a good alternative investment, very risky. We'll never give advice to invest in that. It's not a regulated instrument. We did, however, do a lot of research so that we can provide clients with the necessary guidance. So Herman, please send me an email to that email address in info@globalinvesting.co.za, and then I can just help you make the right decision. But there was an interesting article published in The Economist, a very renowned magazine article, where they did research using modern portfolio theory, which is the base of every fund manager, investment manager currently alive. And the theory showed, and the research showed, that a portfolio should have 1 to 5% allocated to cryptos. It actually improves your risk-reward ratio in the short, medium, and long term. So yes, please speak to me, and we can provide some guidance. Davy, do you want to say something? I see you're smiling, or we're going to leave it there.
No, Francois, no, I don't want to. No, I think you've covered it nicely. As you know, I am very excited about this technology, yes. But you have to be very seriously careful about so-called cryptos. I prefer to call it private money, but it's not only money; it's information, basically. But yes. I'm very, very, very excited about this.
Cool. Thank you, everyone, for joining us. There will be a recording. As you see, we've recorded this session. We will send a follow-up email with the email address where you can contact us with the recording as well. So you will definitely be able to get hold of us. Thank you very much for your time tonight. Have a wonderful evening. and happy
Dankie
holidays.
François, dankie vir jou.
Goodbye, everyone.
Thanks, everyone. Bye-bye.